an intro. Thanks everyone for joining, and especially to our panelists, Colin, Harry, Riley. We're going to be talking about SPVs. We're going to go past the kind of 101 into some real tactics. I'm going to talk as little as possible because I have nothing valuable to provide in contrast to our panelists, but I'll guide the conversation along as best possible. I'm Halle, as it says on the screen. I think we'll do intros on the next screen, maybe. We have our table of contents first, so this gives you a little sneak peek. We'll start with some introductions, but we'll cover everything you want to know from getting set up, the pitfalls and considerations of SPVs, what you should expect in terms of economic terms, when an SPV isn't quite right or not enough. And then we will, as always, leave time for Q&A. But don't feel like you have to hold your questions to the end, especially with the smaller group. I think it can be fun to integrate questions throughout. So feel free to drop them in the chat. Please don't feel free to come off mute and interrupt, but we will integrate questions through, especially if they are related to the topic at hand. But also we'll have that Q&A at the end. So without further ado, like I said, we'll do intros and I will start. My name's Halle. I lead growth and marketing at Sydecar. Sydecar is an early stage fintech platform in the alternative investment space. So we help people set up, structure, and manage SPVs and funds to invest into startups. And then we can go maybe Colin, Harry, Riley.
Hey everyone, Colin, good to meet you. I'm the founding partner of Yonder VC. I focus exclusively on investing in early stage marketplaces, and also the lucky co-host of Wannabe Angels with Harry here.
All right. Thanks, Colin. Yeah, my name is Harry Campbell. I run a media business called the Rideshare Guy, which has sort of been my day job for the past 10 years. And then over the past few years, started angel investing and have a small fund that we do 25K early stage checks in anything mobility related. And yeah, Colin and I also have our Wannabe Angels podcast and are both big fans and users of Sydecar too. So I think that'll be a cool element to talk about since I do all of my deals as a syndicate. I syndicate all of my deals. So happy to get into the details today.
Awesome. Hey everyone, I'm Riley. I'm at Valia Ventures. Been there the last 7.5 years that we've been building the firm. We actually started out as a firm exclusively doing SPVs for about 1.5 years before we raised our first fund. That was a very small fund, so we kept doing SPVs from 2018, from Fund 1 all the way till we closed Fund 2 about 2 years ago. So we've done a bunch of them. We also used it as a way to build our own firm in case that's a helpful angle here, and also been an investor in about 20 different syndicates. So yeah, been a user of syndicates, an investor, and also someone who's run a bunch of SPVs in the past. Less so with Sydecar. We were getting going before Sydecar was up and running, but I think it'll be great to have their team on and share their experience, and also some super active users as well. So thanks for having me.
Awesome. Thank you guys. So we'll start at the beginning. Like I said, we're not going to go all the way 101, but want to talk about kind of the why SPVs, and Riley already hinted at this a little bit, but I'll kind of open up the floor to the three of y'all in whatever order you want with the prompts on the screen for some of the use cases and really the power behind leveraging SPVs to invest into startups.
I'm happy to kick us off here. Yeah, just to build off what I was sharing. Basically, my partner and I started Valia when we were both in our 20s. We didn't work at Sequoia. We didn't have $1 billion exit. And so it's really hard to go raise a venture capital fund. And so the advice we got was to go start with SPVs as a way to build your track record, as a way to build your LP network. And, you know, like you got on the fourth bullet, you also get some upside if any of those work out on a deal by deal basis compared to a fund that's 10, 12, 15 years long. So our specific goal for SPVs was to do all those things that allowed us to raise our first fund. Then alongside that first fund, we kept leveraging them to then get towards Fund 2. And we're now finally at a size where Fund 2 as a $50 million fund was big enough for our 3-person team. But we were huge users of them along the way. And what we do now is, as early stage investors, as our companies grow, We'll do a pre-seed seed round, maybe follow on at A. As those companies continue to go, we'll keep doubling down and try to get bigger allocations through SPVs and Series B, Series C, later stage rounds. So yeah, that's the power of it for us. It helped us build the firm, helped us build our brand, LP network, track record. And so it's a big part of our growth as a firm.
I'll go, Harry, unless you.
Sure.
Yeah, I mean, I think I had a very similar experience to Riley. I kind of got into it in a much different way. I'd been a long-time operator building marketplaces, and then was kind of advising, consulting marketplaces. And there was companies that I was working with that were ending up raising rounds, and I was like, huh, I really feel like I should get more exposure here in these companies. And someone was like, you should do an SPV, and I was like, what's that? And so that sent me down on the road of searching what that acronym meant, first of all. And then fortuitously was introed to Sydecar very early on. And it, really kind of fit for me what I was looking for. I don't think everyone that does SPVs from the beginning, has the ability to go out and raise 100K plus, 200K, 300K for every SPV. It's actually quite hard to do that on unless you have a really solid network. And so, what I really enjoyed about Sydecar was the entry point from just the automation, but also the price point made it such that I could do check sizes that kind of fit within my network. And that's what got me going, and I loved it.
Yeah, that's cool. And I think it sounds like the three of us sort of all have a lot of, find a lot of value in SPVs, but sort of use them in a bit of a different way. And I think for me, I kind of like what Riley said that, it's a deal by deal basis. So I'll be frank, I'm not a super rich guy yet, like some of the VCs or some of the people like, I think the like kind of the deal by deal aspect, is like, I'm not expecting to make money off of these SPVs anytime soon, but like if I could get a big check in 7 to 10 years and, when you do it on a deal by deal basis, those winners, you get all of the upside. So frankly, like I think that that's maybe not the only reason why I'm doing it, but I think having that potential return is pretty important to me. I think that would make like a material impact on my life in 7 to 10 years. So I think that's one aspect of syndicates that is value for me. And then I think also too it would like the structure of my quote unquote, I'll call it more of an investment vehicle. I have one LP that basically gave me a 500K check to invest, and I do a 10% GP commit. So I put in 10% on each deal, and it was just structurally it was a lot easier to not do a real fund for that small of a fund and do. So every deal we do, I do a 25K check from my LP. They don't really have a say yes or no. Well, I mean, they could say no, but they always say yes. And so it's sort of like it is my fund. I put that 25K in, I put the 2.5K in, and then the fees are very reasonable on Sydecar, which was, I think one of the things that attracted to me. So with that structure, it kind of allows me to sort of do like a quote unquote fund in a syndicate format. And then, when I do find, other good, LPs or, people that want to join in on a round, I'm already syndicating the deal. If I tell the founder if he's got small checks that he doesn't want on the cap table, they can join me. And, this is kind of, I think that sounds good in theory on paper. And maybe when we talk about some of the challenges of SPV, I'm happy to get into it. It doesn't work out as well in reality, like what I just described, because people with syndicates, they want someone that's a big name investor, or they want like, big, later stage SpaceX secondaries that they could sort of put on their LinkedIn. Like, no one wants to come in with me on these. Like my last deal was like a crazy golf startup. That's a little bit tougher to get like, people to put their hard-earned money, when it's pre-seed, no product, or, maybe a product, but, your founder is untested. So stuff like that. So that's kind of how, I definitely am a big believer in SPVs and how I've personally been using them.
Awesome. Yeah, I want to pull on something, part of what you said, Harry, and then Colin, related to something you said too, is on this last bullet point of, Harry, you're talking about having one LP, which is very different than when you go out and raise even if it's just a couple $1 million venture fund. Like if you have any LPs who know what they're doing, and want to have a say in terms of what your portfolio construction is going to look like, what your thesis is going to look like, that, to a certain extent, it's reasonable and doesn't completely limit you. But as you raise from bigger and bigger LPs, you start to be more limited in terms of what you can do. And it's less about just getting in on those exciting deals that, the crazy golf startup or a deal that your friend's doing. And it's more about, really being like a true fiduciary. And so can you, whoever wants to, but talk about some of the benefits of SPVs in that respect, of not really having to think about building a formal, constructed portfolio versus just investing in the deals you're excited about.
Yeah. What do you think,
Yeah,
Colin?
I'll weigh in. So I'm a little bit like Riley. So I just launched my first fund on the Sydecar platform. So I'm happy to be doing that. I also try to syndicate every deal I do in the fund as well. Um, and I think the big thing for me is I learned a lot that there's a difference between fund LPs and like SPV LPs, I would say. And kind of to your point, you know, in the fund, people really want me to pick and bring my expertise to bear and do those things, and they're investing in a very narrow scope of like, hey, this is exactly what you set out to invest in with these parameters. Go do that, right? And do that, and the more you do that in that bullseye, the better. And the SPV investors that I have are much more opportunistic on finding a good deal, right, that they're interested in. And so what I end up finding a lot of is that there's a lot of fund opportunities that come up that aren't actually necessarily great for doing an SPV on. Like they may be early stage, they don't have like some name investor involved, and so it actually won't be super successful as an SPV. On the flip side, there are also things that come in that may be later stage than I focus on. I do like first check in, early stage marketplaces, and they, like I'll get like a late stage marketplace that comes in and it's like, well, that doesn't fit the fund thesis. I can't write a big enough check to, get percentage ownership that makes sense. And so, but it actually is a great SPV opportunity because it already has traction, name investor, easy for people to diligence on their own. And so I kind of view it as this way for me to actually catch all the great opportunities and do really interesting things that I couldn't otherwise do. But it's also been a great relationship builder. So like one of the things I've been doing like somewhat successfully now is that like family offices, for example, if you're an emergency manager, they want to get to know you. They don't want to just cut a check because they got introed and someone said you were cool. They want to see what you're doing, right? And so actually one of the best ways been doing that has actually been doing SPVs and allowing them to come in and do the diligence with you. And so I've been really enjoying that piece of the SPV part, is that I can actually kind of have a try before you buy model with people. And it really opens up the aperture of who you'll work with. And specifically fund to funds also like that. So I don't know, I kind of view it as like this flexibility that comes with SPVs that doesn't come with the fund. Like if I was only doing the fund, I would be like basically just doing one type of workout and I couldn't do all these other things.
Yeah, Colin, that was a big part of our growth too. I mean, we went from a very small fund one to a decent sized seed fund for fund two, and a big part of that LP base were people who participated in SPVs over that initial 4 or 5 year period for us as a firm. So yeah, it was a big part of our growth in LP base because it's easier for someone to commit to a deal than a 10-year blind pool fund. So yeah, it's definitely something. If you are building a firm, you're an emerging manager, you have someone who's interested, not ready to commit, bring them into SPVs can be just a good way to keep that relationship warm and start some level of engagement without a formal LP commitment.
Awesome. Well, next topic is getting set up for success. And we heard from Colin that the first thing he did was Google SPV, but maybe there are a couple steps after that in terms of figuring out actually how to go about and do one of these deals, but not just operationally execute it. Also, like, what do you need to know to have thought about prior to launching your first SPV? So, Colin, I don't know if you want to start on this.
Yeah.
Because you kind of talked about maybe feeling
Halle,
like,
I'm not gonna lie. When you said SPV, I was like, oh wait, crap, what does it? It took me like 3 seconds to remember. It's special purpose vehicle. Is that right?
special purpose vehicle.
Okay. I
Maybe
almost
we should
Googled
have
it. I
covered
almost
that.
Googled it, but you get so used to saying
Yeah.
the acronym, right? You kind of sometimes forget because it doesn't actually, represent maybe what people are thinking of, right? Like a special purpose vehicle. What is that?
No,
So,
it really it doesn't have any onomatopoeia, kind of like it
Yeah.
doesn't sound like what it is, like yeah, I think that's a good question. So what I wished I had done before when I first set up. One is it's great sidecar. You can do use their series LLC to do essentially one of the deals. But I think one of the things I wish I had done sooner or had kind of known was to actually set up my own series LLC up front, which it would have been more expensive to do but in hindsight would have set me, it doesn't matter, I would say, like it's not like this huge problem, but it would have been cleaner in the long run to do that. And so that was the one thing I like in hindsight wish I had kind of known more about and would have wanted to have done. Um, but other than that, I think the big things are really like how to write a deal memo too. Like, it's not just like, hey, I'm gonna go raise this SPV and then here's the deck from the founder, throw some checks in. Like that doesn't work that well. Like it really just doesn't. And like what people are actually looking for largely is some analysis and kind of proof that you actually went through and analyzed this, and like what your skin in the game is. Like what's your, like how much are you putting in? Like that's one of the probably most common questions you get from people doing SPVs is like, well, how much are you putting in, right? Um, and I think those are a lot of things to start considering and thinking about is like, what is your long-term strategy around how much can you put in per deal? What makes sense? And how you make sure that makes sense over time. So, and then I saw a question, does that mean setting up your GP? Yeah. So I would highly recommend that, doing that, doing the Delaware, everything. Just if you're planning to do this professionally in some capacity, I would set up your GP entity, even if you're going to do it on your own, I guess, like, over a long period of time, I think it's cleaner. But spend a couple $1,000s to just do it right the first time and go from there. It'll make your life easier.
Yeah, I mean, I'll sort of take not necessarily like the other side, Colin, but I feel like the nice thing about SPVs is that you don't have to do much setup. You kind of like when you have a deal, you're like, go to Sidecar or go to one of the platforms, you fill out, it's pretty self-explanatory and kind of do it. Like if you want to dip your toes in, I think what you hit on is the important, like if you want to kind of actually have success with the, like the actual implementation of the SPV, I think is very straightforward. If you want to have success, that's where it's a lot more important to start thinking about like what can you do now to plant some seeds like, hey, who do I know that, is interested in these areas that align with what I'm doing that might, write a check that I could sort of, because it's always, I think that the hardest part to me with the SPV is like, how do you get the allocation from the founder and then also like line up the investors, right? Because like if you ask the founder, hey, I need 20, I can do 25K and, then you can't go and raise that 25K, you kind of look like an idiot to the founder and vice versa, right? So sort of like, what can you do? I think it's more, I think more often than not, like getting the allocation, I would say, is maybe not the easier part, but the more doable part. And then it's finding the folks that want to invest, right? So to me, thinking about like, all right, what are some areas that I'm interested in that I might be able to get allocations in? Who are potential LPs that could fit that? Who has a track record of angel investing? Or a lot of times, just like I found with a couple of the first syndicates I did, like I was kind of surprised. Like, this was maybe a few years ago, so people were doing a little bigger checks, but I had a few people that put 25K checks in who I was a little surprised. I was like, whoa, I didn't know you made that much money. That was like a nice surprise. So I think, kind of just putting it out there, maybe that you're doing syndicates or you're looking at investments, right? That, you kind of have an interest in this area before, because you can't mention a specific deal even when you do, but like, kind of putting that out there that just to sort of like shake the trees a little and see who in your network is interested, have a conversation with them about it so that when it does come time, you can text them really quickly, like, hey, I've got this allocation, level of 1 to 5, what's your interest level? Maybe you're not going to get a hard commit right there, but you've got some sort of seeds planted so that when you do kind of get like a soft allocation or a hard allocation, you're like a little bit more ready to go.
Riley, I'd love to get your perspective because Colin especially talked about this, which is like setting up for your future success. And everyone knows like VC is a long game. So I would say most people don't get into it thinking I'm just gonna dip my toe in and then jump out. Usually when you try something new, you want to be successful. So maybe you didn't know you'd go on to raise this much bigger fund after 7 years, but you probably had some inkling of what you wanted Valia to grow into. And so were there things that you did or maybe wish you did early on in terms of setting up for scale, setting up to be like a legacy kind of more established fund?
Yeah, we very much saw SPVs as the path to raise a fund one, and that worked. And then the path from fund one to fund two is you need great return, great performance data from fund one, but we also had to expand our LP base significantly, and that's where SPVs came in. I think what we did wrong is we did a lot of very small SPVs that just in hindsight, and this was all before Sydecar was even formed as a company. So we were spending money on fees on really small vehicles, but we thought it was an interesting company. We wanted to expand our LP network. We wanted to build our track record. And so we did 25 and 50K SPVs off of a platform like Sydecar. And so those fees are setting up the entity, but then every year filing tax return. And so all of a sudden you raise a 25 or 50K SPV, and a few years into it, you might have spent $5,000 to $10,000 on expenses. And we can talk about management fees a little bit further along, but that was a big mistake we did, is we should have set a higher bar for a minimum on SPV off of a platform like a Sydecar. And so we eventually just started having to take money out of our own management fees to fund these things, because there were no real dollars, and we didn't want to have to call back these LPs and say, hey, like, remember that thing you put $10,000 into it? Can you give us some more money because we need another $1,000 for our accounting firm? And so that was a big mistake. Today, our minimums, and to answer this question specifically, Dominic, I think outside of a platform today, we look for very large SPVs. I mean, if we're doing something outside our fund, we won't do something less than 500,000. Our real goal is more like $1 million per SPV, but that's outside of a platform. That's, we've been doing this 7 years. We've built our LP relationships. I think if you're just getting going and you're using a platform like Sydecar and you have some protection on that fee burden, then if you can do something that's 50, or Harry's doing things that are 25, there's still benefit to that. One of those $25,000 investments could be a 10x, 100x, and Harry and his LP could make a lot of money on that. And so I think for us, the main mistake when I think about SPVs and firm building was we did a bunch of these entities, which are standalone entities, which are now expensive to maintain, and they were too small.
Yeah,
But,
I guess, Riley, that's sort of how I think about it, and that especially if I'm doing early stage, pre-seed and seed, right? I'm going for less of the 3 to 5 and more of the hopefully, 5 to 10x returns or more. And so if you're paying $5,000 in fees on a $25,000 investment, that seems, 20%, is my math right? Yeah, 20%, upfront, or, over the lifetime in fees, which isn't even that bad, but like might sound like a lot, relative to like a stock investment, right? 20% in fees sounds like a lot, but that fee doesn't scale with the return, right? So if you make $200,000 now, that $5,000, is a tiny fraction of 1% or less, right, of your potential return. So I think that, at least in my head, that's sort of how I've thought about it, is that, I'm going for the big returns. And again, with SPVs, since you don't have to pay back the losers, right? In a traditional fund, every month, every dollar that you lose, you don't get any money until you pay all those back, right, to your LPs. And then you start getting carry, right? If I get that upside, I literally just made $200,000 for my LPs, and 20% of that, the fees are pretty negligible at that point, right? If you do get lucky and pick a big winner or have skill, I guess you'd say too.
But I think that's where the benefit of a platform comes in, because we were paying for fees every single year out of pocket, and we had initial startup costs of 2 to 4K per entity.
Yeah.
And so that's where, if you're doing something off of a platform, your fee burden can just keep going up and up and up. And for us, like we've been taking money out of our own pockets to cover expenses for these SPVs, because we didn't want to reach back out to those LPs. And so, yeah, I think, when you think about success, there's 3 parts of it. I think you need access to a good company, because it needs to be a good investment. You need to figure out the structure. I think Sydecar and the platforms have helped enormously with that. And then you need to raise capital. Specifically on the second point, like if we had started over today and Sydecar existed, we would have done a lot of those specific deals on Sydecar, because they make it much easier for a manager, for an LP, for operations, fee burden. And it just didn't exist when we started in 2017. And so we were doing these things as individual LLCs.
Yeah, and part of that is, it's just like the innovation cycle. So no one could have charged what Sydecar is now charging to do these vehicles in 2017, would be what I would argue. There's been so much development from everything around regulation to actual just technology, and platforms that have come before us that have carved the path and created an appetite for SPVs. So a lot more is possible now than maybe once was.
Yeah, even relative to other folks in the market, I was looking yesterday, AngelList is still an 8K minimum. So as you think about smaller deals relative to fund burden, that is math you have to think about when you're evaluating different platforms.
And ultimately, the bottom line is it depends what your LPs will accept, right? So like when you're doing these deals, in most cases, the fee isn't actually something you're paying. If it's a SPV done on a platform, to Riley's point, it can end up coming back on you if you have these recurring fees. But upfront, especially formation fees, are going to be passed through to the SPVs in the fund the majority of the time. And so it really comes down to the fact that if your SPV fees are over a certain percentage, that's just less exposure that your LP is getting to the deal because their money is going to fees instead of to the deal. If they're okay with that, then Sydecar doesn't, for instance, say there's no platform minimum for deal size on Sydecar because our perspective is that's between you and your LPs. I do think there's some like common thinking around like what percentage fee LPs will be okay with, but there's definitely some variation.
Yeah, and a quick caveat, Dominic just asked a question, was our recurring fees on these entities I'm talking about, we pay our fund admin. So our fund admin we use as a fund, we use for fund 1, fund 2, our management company, and then we also include our SPVs because LPs ask questions about these. And so we want to include under one portal, a place where they can see all their investments. So we pay fund admin fees every year per SPV. And we also pay annual filing fees. And so that's where every year, we're spending more and more money on these entities, and some of them were just really small. And that was a lesson in hindsight.
Yep. And Sydecar made the decision in our pricing model to bake in those recurring filing fees, blue sky, regulatory fees up into that upfront fee. There are things that you can incur, whether if it's a super complicated deal and there's ongoing legal expenses for some reason associated with the deal, if you have to get your SPVs audited, which is becoming more and more common, especially depending on what your LP base looks like. Those are all fees that you could potentially incur on top of Sydecar's fee that might be recurring. So always ask your lawyer is the answer I'm supposed to give. Cool. Well, so we've teased this a little bit, but there are some challenges with SPVs, and maybe there are some cases in which they're not great. So we got into some of these, but would love to go deeper on whatever kind of sparks interest. We've talked about fees. We've talked about setting expectations with founders. We haven't talked as much about the rights piece of it. So we'll open the floor for whoever wants to jam.
Oh, where to start? I think the biggest one for me has been the follow-on piece. I think is kind of like and I know you guys at Sydecar have tried to solve some of this with I'm forgetting the fund name, but trying to help kind of provide some of that like follow-on capital with the SPVs, because I do like it is funny. It's like you get an SPV allocation, they give you pro rata, and you're like, you sell your LPs on like this is a positive, and then you're like, then I got to go back to the well, when the next round happens and raise an SPV, and I don't know, those people may not want to put more money in, right? Or like they've done their allocation, and I think what's interesting is like from a GP perspective, person doing the SPVs is like you kind of view it as your portfolio and kind of adding on, right? And so the underlying LPs don't necessarily matter as much to you, but for the individual LPs in the first SPV or something like that, they may not want to follow on, and so they're actually kind of getting diluted and losing exposure. So I think that's one of the things that I've been thinking a lot about and trying to strategize.
I guess it's a little
of like
tough
how
to
to
follow
handle
on with another SPV, is what you're saying, right?
Yeah, exactly.
Yeah.
I mean, well,
Like, if
you
you've
just
got a
have to go.
fund,
Yeah.
if you've got a fund like Riley, you might be investing early stage and then using the SPVs at a later stage to like essentially follow on, which is kind of a nice model. But when you start with the SPV, it's hard to do another one. I think I've definitely experienced that too.
Riley, what is the fund's follow-on strategy? Do you have reserves? Are you doing follow-ons with SPVs?
Yeah, we have reserves in our $50 million fund for one round. So if we come in at seed, then there are some dollars there for A, but all of a sudden a year later, Series B rolls around, or 2 years later, and the fund's basically tapped out because it's really just an early stage fund. So that's when we'll leverage SPVs. But then the nice thing in that is like if you're a fund LP, you've seen or heard about this company, hopefully it's performing, and then you're like, oh, I like that one, I want to put money directly into that. Versus the point that Harry was making, if you've already shared this opportunity with all your network and these 10 people want to invest, everyone else already wasn't interested the first time. So there has to be something really strong coming back to that same base for the subsequent round. And it might be there, but it is tough. I mean, we haven't had a lot of success with doing an SPV and then a follow-on SPV after that.
Yeah.
Yeah.
I think psychologically that makes sense too, Riley, right? Like since you are the fund, you're kind of making the investment choice at the seed and then, maybe even a follow on. And you're right, like these investors like even just have seen the name pop up. And obviously if you're doing an SPV at a later stage, it's likely because they're doing well. So I think that could be a nice way to kind of like very softly tap into LPs for additional, dollars if they've got, capital at that time, so I sort of like that strategy much more so than the reverse.
Yeah,
Yeah.
and I mean, there's got to be a piece, there always is a piece of this that's a sign of the times or a product of the times too. Raising, I forget when you said Riley closed the fund, but raising a $50 million fund with reserves in the current environment or the environment of the past couple of years is an incredible feat. So kudos to you, but not one that many people have accomplished. And so you are seeing more funds, even if you're going out on your second fund or third fund raising less than the target and maybe not even being able to keep reserves because you didn't raise enough to. And that's where SPVs can be powerful. But yeah, once again, it is a challenge with, there are so many benefits to SPVs. They've opened up this whole world for people who maybe never otherwise would have set
Yeah.
out on this career path. But then you get to the point of follow-ons where the check sizes are getting bigger, and where does that capital come from? And I
Yeah.
did want to shout out, Colin mentioned Sydecar as a program in collaboration with MDSV Capital, called the Capital Extension Program. And basically the thesis there is, I'm going to try and get the stat right. I think it's like 90% of unicorns had like an emerging manager back their earliest round. And yet, as you go on through the rounds and as those companies are successful, those early emerging managers are getting diluted because they don't have the capital to continue to back companies. And we've seen all the stats about emerging managers outperforming from just a data perspective. But there still hasn't been a great mechanism created for those managers to get capital to participate in the larger rounds. So MDSV is trying to solve that. And there are other firms that do like partnership around pro rata, but I just saw an article, I think from PitchBook this morning, about how 44% of all LP VC dollars raised this year went to Andreessen and Sequoia. Like, it's just a mind-blowing statistic.
One
So
additional
that wasn't a question.
Statement, mic drop.
Yeah. One thing I'll add too is more around LP management, in the sense that sounds like Harry's done a lot of this work. He's found an LP who understands the risk profile and he's diversifying into early stage venture with 25K checks, which is smart. One mistake we've seen with LPs is they've gotten really excited about something. They've gone in heavier than they should have, and they don't think about the power law and distribution required at early stage venture. And so they go into heavy in a deal, and as is normal in the world of startups, a couple of years later, they don't make it, it's not working out, and all of a sudden, venture is bad, investing with you is bad, I'm never going to do another one of these things. And so even if you have an LP who's really interested in doing a big check, depending on your goals, you might be much better off trying to scale them down in some ways to bring back a repeat customer versus trying to get them, every dollar as much as possible into one deal. Because if we're doing early stage SPVs, I mean, we know the likelihood of these failing. And so I think there was one lesson and pitfall we had is we had some LPs who came in heavy, a couple deals didn't work out, they're tapped out and frustrated. And so we basically burned that relationship. Whereas if we could have diversified them a little bit more, maybe 1 of 10 would have worked instead of 1 out of 2, which is just really hard when you're doing pre-seed, seed, even Series A investing.
Yeah, Harry and I have talked about this a lot on the podcast, about angel investing. So I think it's the same thing. It's like, I think our conventional wisdom is take whatever number you have in your mind and divide it by 4. And I think pretty much everyone we've talked to, made by 10. Pretty much everyone we've talked to has said they would go back and do smaller, more consistently sized checks. And I think that's like just and you talk to LPs, I always talk people down, which I know sounds insane, but I like to think long term about if I could have them invest in every deal rather than just one deal and getting it done, because I don't think that's like not a long-term sustainable strategy. But so
I'll be
Yeah.
honest, I haven't really done that, but I might steal that one for the future because it does make a lot of sense. And I have had, like I think I mentioned a couple folks that did 25K checks with me early on and haven't done another SPV with me. And, they were sort of my go-to. Like I would text them like, hey, what do you think about, as sort of anchors, and hasn't. So that definitely, maybe if they would have cut that in half or four, they might have done more consistent deals with me for sure. Like I think they knew what they were getting into. And I don't know, I'm kind of my personality. I often joke, with people who want to invest with me. I'm like, okay, just as long as you're ready to lose your money, just so like I don't want to like oversell, especially with early stage. Like that's sort of a joke. Maybe it's not the best way to market your deals, and why I sometimes struggle to get LPs into my deals. But I sort of use that as like the, hey, my CYA, right? Like, hey, this is risky stuff. And, I'm not approaching anyone who doesn't understand the risk, but just to reiterate that risk. But I think that might be a nice way of sort of softening, but also developing that relationship and finding a repeat customer and partner.
Yeah. I think that's a prudent strategy. I think one of the, maybe we could talk a little bit about the fun of talking to a founder about like what the allocation should be. Because there's one thing to get an allocation and say, yeah, I'll do 100K. And then there's the other part of, can I fill 100K from my LPs? And you don't really know, right? And like, I'm sure some people have done a better job of like doing some kind of survey email to their, or something to their LPs to get like just the soft circle of what they think they could do. But largely that's not how it works, I think, with SPVs. And so, it's like they're like, what range can the founder's like, what range can you raise? And you're like 0 to 200,000. And they're like, well, what amount? You're like 0 to 200,000. And because it's, it is like, I find it a bit bimodal, where it's like either you don't really hurdle enough to make it happen, or you like way over raise the amount you need to make it happen. Like that's kind of like been my experience. And so, you want to live in that world where you're kind of in the right side of the bimodal distribution, where you're over the amount that you wanted to do. But I just think it's funny to set expectations with founders. It's like, it's really hard. Like they're used to disappointment in the fundraising process. So I think they're generally like okay and like not critical of you. But I just find it, yeah, that first conversation about how an SPV works and like how much you can raise, and wait, you don't actually have the money raised, like it's always interesting and delicate.
Well, and I think that's why if you're targeting deals where, Colin, you're known for marketplace, I'm known for mobility, right? If you're targeting deals where you can add a lot of value, or you have a relationship where the founders are going to like give you a little leeway, like you got to be bringing something to the table. And I kind of have been a little bit more upfront, like, yeah, syndicates take a little bit more time. I can't just wire a check today. If I have multiple LPs, oh, sometimes they need to get re-verified, or, oh, we messed up, one little thing, or, you know what I mean? There's like a little more, there are more moving parts. So I do kind of set the expectation like, hey, it might take a week or two, but I've never had a founder push back and be like, hey, that's too long. We're going to cut you out of the deal, right? Because I think the ones that I'm targeting are ones where I can help a ton. I can add a lot of value. People send me deals all the time. And if it's like, I don't really know much. It's interesting. It might be a great company, but I can't really do much or add much, then I usually turn them down. Colin just sent me one the other day, and I think I turned you down, Colin, because it wasn't like up my alley of where I can help a lot. Sorry. But with the ones where I can and the founder's willing to be a little more flexible on that allocation, on that timeline, I sort of try to be upfront in that, like, hey, in the past, I've been able to raise 25 to 50, but it might be a little bit more. And, so I think just setting the expectations up front and making sure that they are deals where you're bringing something to the table when it comes to syndicates, sort of like I've never had any pushback, because I think I've kind of focused on those, more so lately, setting the right expectations, but always finding deals where, I'm important to the founder.
Yeah, that's awesome. I mean, I think I think it seems obvious to just be honest, but I think that's not always obvious, just in terms of, you feel like you've fought hard for this allocation, especially if you're early on and want to set a good impression, or don't want to piss off the founder, don't want to, you've heard that you could lose your allocation if you don't move fast enough. These deals always move fast, and it seems like it's always a better bet to just be honest. And I mean, Colin, you joke, but like it's better for the founder to just hear that 0 to 100 or to 200 from the beginning, rather than to, force you to say 100 and then have it not come out that way.
Yeah, I mean, I think I think the thing that I found to be really useful for the founders is how you frame it. And I think Harry hit on this a little bit of like, hey, can we take up your small checks too? Like, so I kind of like positioning the SPV as a service almost to the founder, where like, hey, look, like, because there's so many founders that be like, I like this person wants to invest 5K. Like I spent all this time and effort. I was really wanting a 25K check or 50K check, and which makes sense because it's like, it's their time. They're trying to get a lead. They're trying to get a bigger check. They're trying to get to $2 million for their pre-seed. It's like, and 5K checks just don't move the needle. And so a lot of times what I've been doing with founders and specifically with the fund now, but the way my fund works is I write an anchor check and then I SPV alongside. And so it's one check into the company through Sydecar, which is amazing to do. But now I just kind of tell founders up front is like, hey, look, whatever we get on there is gravy. Like I've committed my money. The fund's going to invest. Whatever comes on top of that, awesome. Like just let's not worry about what they allocate, like how much it is, you'll get it. It could be like 25K, it could be 100K, like, but I'm at least writing that check. And so you're guaranteed that. And so they're pretty happy about that. And then I go to them and say, hey, look, I know you're busy. If you have a bunch of small checks or friends and family or anyone that you want to put in the SPV, just let me know, send them to me, I'll handle them for you. And by handling them, I can use a Sydecar to do all that. So it's like relatively easy. And so, I think that's a way that it makes it like really interesting. And I've been able to aggregate some pretty large SPVs that way, where you maybe tell the founder like, hey, anything under 25K, why don't you don't want that on your cap table. Like, and I talk to a lot of founders about this because I just went through a merger with a company I'm on the board of, and they just had like a party round type caps table where it was just like, I don't know, it was like 100 people on the cap table, and getting votes to like pass that was like a nightmare on like a
I mean,
time. It
even
was like
just getting all 100
yeah,
to sign the documents for like a seed
it,
round, like you've got, Latham
yeah,
Watt or, some fancy lawyer, and they've got to send, that's like $1,000 right there per per investor that they're spending to like,
exactly.
one signature from those guys or girls.
Yeah. Yeah, and there was a 24-hour turnaround time frame on the signature too, and it was like the founder was literally just like, and so I tell founders now, I'm like, this doesn't matter until it matters, and you
Yeah.
want to be able to make one phone call, and I'm the GP that'll do that one phone call for all those people for you, and I think there's like actual real value there for SPVs that isn't talked about a lot from that perspective.
Well, it's a little bit of a good segue into this topic. So what fees are we taking then? Because Colin, that was a very specific example. So we can talk about it with that example and more
Yeah.
generally. But like, how do you deal with fees if you're taking basically their angel investors into your SPV?
Yeah, the capitalist in me tries, wants the 20% carry on it. But usually what I do is I say, look, if it's under like over 5K, there's no carry on it. But if it's like under a certain amount, there's just like 10% on it or 5%, something like that. Just to kind of like, because like for me, I usually do 20% on the SPVs, no management fee, in terms of just how I have done them. And there's like a lot of, path dependency there, and SPVs have just been done that way for a long time. And yes, would I have loved it to be different, and to make more money off of them for sure. But that's just kind of been like, market terms in a lot of ways. But anyway, but I also just try to encourage, like, if people are going to come in like doing a 1K check, it's like not really worth my time and energy. So I try to make it like incentivized to at least come in over 5K or something like that. So
That's smart.
that's how I do it. Yeah.
No, I think
Yeah,
that makes sense. Yeah. Any other just general fee guidance?
Yeah, I also do the 20% and no management fees for the syndicates, which I think is pretty standard. I mean, based off this slide too, most people, almost everyone takes some carry. Maybe it's not 20%, but that's typical. And then, some take a management fee. Average on 2%, the 2 and 20 is pretty standard. And I think when it comes to syndicates, honestly, I think for the more emerging managers or emerging SPVs. I think you want to be much closer to like the 20 and 0 management fee. If you're a celebrity investor, you can maybe even, I think Balaji on Twitter said, yeah, I'm doing a 30% carry and, huge management fee. Like if you're more in that direction, you can kind of bump that up, right? Sort of simple supply and demand. But if you're on the other side of the spectrum, I would go, more conservative. And also, frankly, like Colin said, like it doesn't matter. Like who cares about, do you really need 2% on a 1K check? Like you're not going to make any money off of that. That's $20, right? So I think just kind of like, getting people, I guess this is one thing I have done. I have tried to get people into the deal, right? I might waive carry, I might cut it in half. Like getting people in, like writing a check into a syndicate, I think is like a huge 0 to 1. So anything you can do to get them in, if they scout a deal for you, right? Like I think anything that you can do, and there's a lot of different, I've scouted a few deals for syndicates, that have then done carry share with me, right? There's a lot of like carry sharing that you can do with people who are scouting deals or, kind of bringing deals to you that I think a lot of the big syndicates do. Yeah, that's kind of on the fees side. I think like the carry is probably where you're gonna, what I would focus on and making, 20% of the biggest checks, in 7 to 10 years. That's just probably where you'll make your money with syndicates, and everything else. I just kind of like, I'm not too worried about it.
Yeah, we've always been 20%. We've done 10% a couple times, one with a very large LP who has come into a lot of our deals, so tried to be more generous there. And also there was a scenario where we were sharing an opportunity with someone else and we each took 10%. On the management fee side, this is being recorded, so I don't want to share everything, but it's been a very wide range. And so it's been everything from 0 to a lot. A lot is intentionally undefined. But we also needed that early on as we were trying to grow the firm. Today, we're much more flexible and we don't rely on those management fees as much. But if you're a 2-person investor team and you have to pay rent and you can charge a little bit more money on management fees and people will pay it, then you can do that as well. So yeah, I think it's, can you get people to pay it? To Harry's point,
Yeah.
I wouldn't put fees as so much of a barrier that it prevents someone from entering into a deal, because ultimately you need to write the check to even have the chance to be successful. But we've had a huge variance on management fees over the last 7.5 years.
Yeah,
Yeah,
I definitely subscribe to that, Riley. Like if people will pay it, like I'm all for charging it, like this isn't a cat, I think most people, I mean, literally you have to be an accredited investor to invest a lot of this, all of this stuff, right? Like this is not, these aren't rookie investors. People know what they're getting into. And, if you can kind of command higher management fees or better deals, frankly, too, right? Like if you're getting, SpaceX or whatever Elon's latest, secondary is in some hot company that everyone wants to be in, I think that is smart. And, kind of, that's sort of what's fun to me. It's like figuring out, like, I think people have told me, I like the idea too of like, if you can get these big, attractive, later stage secondary type deals for any of Elon's companies, for example, like that's a great way to get LPs into your network. So maybe you charge a lot because you want to make money now, or maybe you charge nothing because you want to build that relationship. It's kind of up to you. There's a lot of paths you can take, and it's up to you to kind of figure it out. That's the fun part for me.
Yeah, I think one thread to pull on there that's kind of an interesting existential SPV question, and really more around syndicates, I guess I would say, is I think early on I was doing deals that I liked, right? Like I was like, I want to do this. And then I think there was some time in there where I would see deals that were outside of my core focus or my expertise, but I could get allocation, and I was like, other people would really like this deal. And I think I did maybe one of those, and then realized that for me, like that's not what I wanted to be doing. Like I didn't want to be pattern matching like what other people wanted to invest in versus like what I was really focused on investing in. And I think that's like one of the things I think people should try and figure out early on is, are you investing, like seeking to get allocation in companies that are highly investable by other people, or trying to invest in things that you believe or have some advantage or some, unique point of view will have returns that, that other people aren't seeing, or that like you believe in. They're not mutually exclusive, but I'm just pointing out that like they're very different strategies, and then the fund economics are very different for those things. Like to Harry's point, secondary and SpaceX, one, there's a lot of like work around that and probably like machinations. So maybe you can charge some higher fees on that. But for a deal for me where I have high conviction and it's very early stage and there's no name investors and very little traction, people aren't going to really want to pay much in fees for that deal. but that's where I want to play, right? And so for me, I'm very much about removing the friction to get people to even get into that kind of riskier bet, or perceived riskier bet, I should say. And so I don't know, it needs to fit like what you're going after. And so I think being able to write down and say exactly what I'm doing is important.
Yeah, I don't know if there's an optimal strategy, and it's more a combination of what your goals are and what you want to achieve. And I think I was right in line with you, Colin, is that like, hey, I want to invest in anything early stage, mobility, pre-seed, seed. Like I've done a lot of checks where there were no other, like I was literally the first investor, right? And sometimes those are the most fun and they've raised follow on or, raised around after, and sometimes they haven't. But I do, and so I think now I've sort of been more open to like a larger, sexier secondary because that might bring in LPs, right? Like that's a lot, it's a lot easier to swallow a SpaceX, right? And then maybe they trust me now and they will invest with me on those crazier deals, right? So I think it, kind of depends on what you're optimizing for and what allocations you can get, of course, too.
So we are quickly approaching our time. We had a little bit more, we have one or two more slides, but I want to share a reminder that you can ask questions in the chat. So I'm going to pause to see if anyone has questions, and then if they don't, we'll keep going with our ending topic, which has to do with a lot of stuff we've already been talking about. So we've covered a lot of this, like where do SPVs fall short? And I'm going to segue this into the next slide, which is like something Colin's teased a good bit, which is talking about a hybrid approach with SPVs on a fund. But once again, if you have questions, please drop them in the chat because we have about 4 minutes left. All right, Colin, let's talk about a hybrid approach, or whoever wants to. Riley, of course, too. I think we've covered a lot of these things, like I said. So when do you start to think about what comes next after an SPV?
Yeah, that's a good question. I think for me, I did like 8 or 9 SPVs, and I was like, look, I enjoy doing the whole rigmarole of doing this, right? Like I would do it for no money, basically, which is what I
You
proved to
like
myself.
working
But
hard, Colin. Let's put it that
yeah,
way.
yeah. Well, no, I'm just saying, like, I mean, I'm doing zero management via SPVs, and I liked it and want to continue doing it, right? And so for me, it was at that point, I was like, okay, well, that tells me that like I want to pursue this line of work, right, as a career. And people will probably pay me to do it if I, raise a fund. But I think for me, when I was thinking about doing my first fund, I the thing that was pretty clear to me was that, and probably Riley had a similar experience, is your first fund is very hard to raise a significantly sized fund without like a actual background of being at a bigger firm or something like that to really do the strategy you want to do. And really your first fund is more about raising enough money to prove out the model of what you want to do so that you can do it at scale, probably in your second, third funds. And for me, I kind of knew it was like, look, getting started was more important with the fund than it was about trying to raise as much as possible for the fund. And so I picked a strategy where I was like, great, I want to get started with a lower amount of like fund size and do SPVs alongside with it with the fund. So basically I kind of view like the amount I raise for my fund and my primary checks, let's say it's 50K or 100K into the deal, I can then syndicate and add another 50, 100K, 200K on top of that. I view that as my fund size has just grown, right? But it's on a like this deal by deal basis, whereas I didn't have to go find LPs to do that money up front and be in every deal. And so I think that's like one way to think about this for people. Such that you don't have to be like this Herculean effort. I got to go raise 5, 10, 20 million for my first fund to make my deal work. Like you can actually do it on a rolling basis and actually get into market. And what I found is once you get into market and you're writing checks and doing deals, LPs want to then invest in you more so than they did when you weren't doing any deals. And I also find that great companies come to you when you're writing checks. Actually, it turns out the best deal flow is investing. And like overall, like once you get going, it's just so much easier. And so, but that's kind of my thing to everyone is like, this is like view like the hybrid approach or the SPVs as a way to just get rolling, right?
We have one question
There's a
in the
question
chat,
here.
which is what type of marketing materials do you normally share with LPs? I think maybe in the context of going out to raise a fund.
Yeah, I mean, I loathe decks, so I just was like, Oh, okay. It's the SPV, not fun. Well, anyway, on the fun side, I just didn't want to do a deck, so I wrote my own long form memo, and honestly, that has been like the best thing I've ever done. And I get a lot of great feedback on that, which translates into SPV is like it's doing a deal memo, right? And that deal memo is like it's gold. And so I've kind of templated what I do, and I can do them really fast now. Um, but I think a lot of the time, what I spend time doing is just texting people saying, "Hey, I think you like this deal. Here's some points on it." And I try to like if people are gonna write a decently sized check into an SPV, I try to get them connected with the founder or do the founder to do like a Q&A or a presentation recorded, something like that to kind of like fast get people interested because the more you get yourself out of the way, like the better off you are. And I know it sounds counterintuitive because like people think about access and all this. It's actually getting people closer to the investment makes them more likely to invest.
Definitely, when I've shared deals with LPs, they'll ask me a lot of specific questions about the company, and like I'm not the founder, I don't always know the answers. So I do, for the right LP, definitely sometimes makes sense to connect. And I think for the founder, it's a win-win too, right? Because they sort of chat with them, but then they're part of the SPV structure eventually too. So kind of get the benefits long tail if they are on the smaller check size.
Yeah, we do a full memo, and then what we'll do if we have a lot of people with the same questions, we'll actually do like a town hall style call. So, hey, you want to come learn more? Here's an hour. You can ask whatever. If only 2 people show up, that's okay. If 20 people
Yeah.
show up, it's okay. And sometimes people like hearing how other people are thinking about an opportunity or what questions they're asking. So it also can be a learning opportunity. So yeah, memo and then deadline. And then if we find there's a lot of questions, sometimes we'll offer a call.
Awesome. Well, I think that brings us right to time. So thank you again to our panelists. Thank you all for joining. We will send out the deck and the recording. So we have a couple great resources linked here, especially the Wannabe Angels podcast for you all. And we'll make sure you know how to get in touch with all the panelists as well as Sydecar if you want to learn more. But thanks again and enjoy the rest of your day.
Awesome. Thanks for having us.
Yeah,
Guys.
thanks everyone.
Great talking, everyone.